Welcome back. You're watching Stock Watch with me, Simon Brown. Joining me to take your stock-related questions tonight, David Shapiro from Sasfin Securities, Wayne McCurrie from FNB Wealth and Investments. Please be sure to send your questions. Email stockwatch@bdtv.co.za or via SMS to 41392 or on X using the hashtag StockWatch. Gentlemen, evening. Thanks for the time. I want to get to some questions coming through, but I want to touch on some results first. Wayne, let's start with you. Growthpoint results. I mean, they talk around still got an office oversupply in Gauteng. Interest rates a challenge, V&A a winner, bit of a mixed bag. Your take on Growthpoint, which is the kind of the granddaddy in the REIT space locally.
Yeah, look, they did warn us about this beforehand because they gave us a guidance range.
Yeah.
So it actually came in, even though it was negative, it came in at the better side of the guidance. It says, actually reading the whole thing, it tells you a few stories. The actual property market itself is getting better. I mean, their vacancies are better. They're not getting such big negative rental reversions anymore. Certainly the V&A is an absolute winner. I mean, they can charge what they like there just about. And they've got incredibly high occupancies in that area. And the tourists are coming back. Office markets looks a lot better as well, although they're not heavily exposed to that area. The overseas investments did quite well. The GOZ in Australia did well. But the problem is interest rates. And it was the increase in interest rates and the interest expense that actually brought the earnings down. I'm surprised they haven't hedged their interest rate exposure more, because I know certainly a lot of property companies who take out 90% hedges, but maybe they brought the hedges down because they're anticipating interest rate cuts, which will happen. Then, of course, if you're not hedged, it actually benefits you. So I don't know what their strategy is, but that was the reason why the earnings were down. Didn't really, last time I looked, it didn't really affect the share price. And of course, the share price, along with all other property shares, or most of them, have actually done quite well over the last few months.
They absolutely have. I mean, David, it's been I think from about October of last year and then again from earlier this year. Your thoughts on Growthpoint? I mean, they do own V&A, which is perhaps the jewel in South African property.
Yeah, you're starting to see the turnaround. And I mean, if you look at their interest bill, it was up almost $1 billion, I think, from a year ago. So it gives you an idea of the gearing or the upside gearing that they face with higher interest rates. And of course, I think the market's down about 3.5% today. And that's really on the back of the lower yield that they're going to get, or the lower payout. But things are changing, and you've got to watch the sector, because if rates come down dramatically, they're going to get the full benefit of that.
Yeah.
But in a way, knows it a lot more, and as he says, things are starting to look better all across the board. And remember, you're also going to have the benefits of lower costs, because a lot of property companies came under immense pressure with load shedding, having to put in place alternative means of power, and took up a lot of expense. So it's a sector, I think, that's going to benefit probably more dramatically from better power usage and also from lower interest rates.
Wayne, could we also see with lower interest rates broadly more attraction to REITs as a sector, simply because of the yield that they offer?
That would be exactly the same as government bonds. When short-term interest rates fall or are about to fall, bonds and property are normally the first sectors to run. Mm-hmm. And I think we're seeing that now in bonds and properties. They're running quite nicely. Now, in theory, the next sector to run is the financial. Now, they might have also started that, but, a good return from property and bonds, sort of as interest rates start to be cut, or in anticipation of the cut, they normally do benefit from that.
Question coming through from one of the viewers asking around Aspen. David, I think Aspen was out last week. I missed the release. I wasn't around, but market didn't seem to like it. The question was, is there a high road for Aspen? Is there opportunity here?
If they get everything in place. And the problem with Aspen is that every time they promise to get it in place, they don't deliver. And I think there's a bit of skepticism out there around the various areas of their business. They've got to, from the manufacturing point of view, They've got to start getting the throughput there. You've probably caught me off guard because I wrote everything down last week, of the various issues that they have. But the markets hasn't warmed to it. Remember, they haven't got their own IP, intellectual property. They manufacture on behalf of others and they distribute on behalf of others. And I think it does add some kind of issues. But I don't want to guess on the various sectors, but they do have the facilities that they need the throughput to come through, in order to get them the benefits of volumes. But let's see, it's going to be another year where they've made good promises. Just hope that they're able to deliver this time.
Well, in your take, I mean, certainly as David says, they've got the capacity, they've got the plants to do the production, they just need to do it. But in the meantime, I mean, is it a stock that looks attractive after a fairly down by almost a quarter?
Yeah, look, I mean, they have taken some strain. I would still be cautious, as David correctly says, lots of promises over many years. Next year is always going to be better. And it doesn't always turn out to be that way. So whenever you read their financials releases, or not all of them, but most of them, when you read them, it says, look, this year was tough. And you get the 5 or ever many reasons as to why it's tough. And then the next paragraph, but next year, going to be good.
That was one of
I'm a bit cautious here.
Yeah, that was one of the first things that was taught to me in markets was go back and look at the previous promises from the last couple of years and see if they've been met. And I take the point from both of you that perhaps Aspen not quite there. What about Old Mutual? A couple of questions coming through around Old Mutual. Certainly lower rates might help a bit, well, even just a better economy because they can sell more product into South African consumers. Wayne, is Old Mutual one on your list?
Look, I'm not overly excited about the domestic insurance industry. I think it's an intensely competitive industry, lots of players, you fight for your market share. So it's not, to me, it's not a huge growth industry. However, good market returns on the back of lower interest rates is great for this industry because they earn substantial portion of their money as a percentage of fees under management or under administration, whatever you want to call it. And if the market goes up, most of that money is exposed to equity markets and bond markets, etc. They just make more fees. And Old Mutual does look cheap, but it's an intensely competitive industry, this.
Yeah, I take your point on that. I mean, David, we have chatted a couple of times on air that I mean, they're just stealing market share from each other for the last number of years. Is Old Mutual attractive?
I've got the same views as Wayne. We need strong markets. You need good economies where people actually go out and spend. At the moment, I don't think people are knocking doors wanting to make investments. And also, they sell products that are, what do you call insurance? There's a resistance to actually having to take out insurance. The other thing is like Sanlam have been doing well because they've become quite aggressive.
Yeah.
Paul Hanratty has actually gone out and making acquisitions and looking to expand his business, which Old Mutual did at the late in the 1990s or when they listed and came back with their tail between their legs and unbundled everything. So I don't think they've got quite the same appetite to expand as maybe Sanlam has.
Question came from our Twitter earlier. What's down with Coronation? Special dividend yesterday was last day to trade. But on that, Wayne, you make the point around better equity markets. Better equity markets should also play into the likes of Coronation.
Yeah, definitely. Coronation, Investec, at least 90, 91, etc. will certainly pay into all of the asset managers. And Coronation, they've got the extra money. They paying out the extra dividend. I think it's a very good business in the longer term, and it certainly is a good investment, I would think, where hopefully we can see some more equity market returns. I mean, even though our market's sitting above 80,000, and the return for the last while has not been bad, there's probably still, I don't know, in the next year or two, 20-25% upside in our market. And that'll be very good for the asset managers because they're totally geared to that. The expenses more or less are fixed. And when the income goes up, it literally just falls straight to the profit line.
Yeah, I mean, David, that's it. And markets go up, they charge a fee. I mean, performance fees are the cream on top. I mean, they just get that extra income.
They get profit fees as well, I think.
Yeah.
There's a lot of profit, when things go up. So they do, I don't want to say gouge, but they do very well. And remember, Coronation actually pay out a lot. They pay out virtually all their earnings.
Yeah.
And they've also got a bonus pool for their staff as well. So they've got to feed them as well.
Well, yeah.
So, but it's a good business. I'm just being a bit, naughty at the moment, but it's a good business.
No, they do.
They have quite recovered. After the tax case, they fell very sharply in that. They haven't quite recovered that, even though they did, win out at the end and got the money that they put aside. But haven't quite recovered the kind of share price,
Wayne, a question coming through to you around the PGM space and Anglo Platinum in particular. We saw the accelerated book build from Anglo American yesterday. The announcement today, they'd sold 5.3% at 515. That saw a sell-off in Anglo Platinum. The question is, if looking at platinum, should we avoid Anglo Platinum and rather than look at an Implats or a Northam?
Yeah, look, on platinum shares in general, I mean, obviously I've been wrong for a while now on this. I still maintain there's a very positive 2 to 3 year outlook. I mean, the big threat of battery electric vehicles seems to be subsiding quite dramatically. And of course, that's good because even if it's hybrid, they still use autocatalyst and you still use platinum and palladium. But on Amplats, I mean, I never thought it would sink down to the low 500s. I really, really didn't think so. It hit sort of 580, 600 a couple of times. It bounced up quite nicely from there. But clearly this book build, when they issued the shares at substantially lower price, has obviously negatively affected the market today. So, I mean, you sometimes wonder about this. I'm getting sort of the feeling I had in 2015 when Kumba and Anglos and everything collapsed around your ears and you almost gave up, and the next thing it just goes through the roof. So hopefully that does help. But I mean, as I say, and I'll reiterate it again, I've clearly been wrong on this one for a while.
Yeah, I remember what Kumba, I think, got to 40 Rand, and then we earned that in 1 year's dividend a few years later. A question coming through, should I be trading FX or buy equity? Wayne and David, I think it's an easy answer, right? Buy shares, stop trading FX. That's for...
Buy shares.
You want to lose money, become a FX trader.
If you want to lose money, take us for lunch.
Enough buying and selling shares.
Yeah, 100%. I take that as well. Let's look at some of the results. Libstar results coming through. David, they weren't a bad set of numbers from Libstar.
No, at long last, things are starting to look up from Libstar. Remember, this is a company that was kind of patched together to go public.
Yeah.
I don't think there was anything naturally organic amongst the relationship, and it's taken a bit of time. But we are starting to see improvement there. It's not something I watch closely. It's really superficial, my interest in it, like I do most of the shares on the market. You look through and something catches your eye. But, good to see it starting to move in the right kind of direction. But manufacturing is a difficult area in South Africa, as we saw from AVI, as we're seeing with Tiger Brands at the moment and so on. So it's not everything moves together. It's one division that seems to kind of take them through. So I haven't got any strong feelings on Libstar.
Wayne, Libstar, because certainly those AVI numbers on Monday were really strong. They maintained their margins. Libstar were good, but perhaps not AVI good.
Yeah, look, AVI, those were spectacular results. They really were. They were exemplary, and the share was discounting good news, and it even got better news, which is actually quite unusual. Yeah, Libstar's not bad. As I do concur with David, it's not something that I spend a lot of time looking at, unfortunately. But whether it's a blue chip and belongs in a long-term portfolio, I'm just not sure.
Yeah, I think food producers generally they're cyclical. I mean, at some point the wheat price goes crazy and that then hurts them. A question came through from AB. He's talking around Pick and Pay. What will the effect be on Pick and Pay share with the unbundling of Boxer? I mean, in essence, it's not even unbundling. It's going to be an IPO. So, Wayne, it's going to be, I mean, in some sense, they're selling off some crown jewels, but they will get cash, which pays off debt, so that'll help. And then we've got a Boxer there. I mean, it's kind of good for Pick and Pay because they get cash. It's bad for Pick and Pay because they're selling one of their better businesses.
Yeah. Look, when you're in trouble, you can only sell the good assets. No one wants the bad asset because that's why you're in trouble. So you are selling off the crown jewels. And as far as I understand, they'll still maintain an exposure to Boxer.
Yeah.
But they desperately need cash. So they're selling off, the good asset to raise some money. And over time, that's never, ever a good idea. But they've got no option. So, yeah.
Question coming through. Let's go. David, sorry, your take on Pick and Pay. I mean,
my only take is that this is a business under severe pressure.
Yeah.
They're trying to renegotiate leases. They're cutting out the amount of space that they actually rent. It's when you get to companies like this, which are troubled and where they're having an IPO of Boxer, in other words, just selling off bits. I have the same views on Amplats at the moment as well. It's a worry when they start to do these things, when you start to sell off little bits of your holdings, and because you know that you're going to have to do it over time, and you're just collecting cash for the short term, to help alleviate debt. That to me is a concern, So I think even Sean Summers would admit this is going to be a long road to recovery, and you don't have to commit your cash to it now. You don't have to play at the bottom end of the market hoping for little bits of gains. Or there are plenty of good companies that you can go into without this kind of stress.
I take your point, but then what about SPAR? Because, I mean, we can concur, ShopRite's the leader. SPAR seems to have got their Sept problem and KZN sorted. They are paying someone to take Poland off their hands, but at least it gets rid of all that stuff. Does it make SPAR perhaps a little interesting?
You've still got this massive amount of debt that they're taking over, which they have to now wind down from other operations. That's a huge issue. That's something huge overhanging your head. Just again, you don't have to go there. Whether it goes up and down on a daily basis, don't look for trouble. You don't have to. You can find something else. You don't have to play in the traffic.
Wayne, you concur with that? Because, I mean, the Pick and Pay is just the leader. I mean, it's never cheap, but it remains the leader for the last decade or two in our local grocery retailing.
You mean ShopRite?
Sorry, ShopRite.
Yeah. Look, I mean, the ShopRite results, that last one that came out, obviously it's a good set of results in comparison to what the rest of the market's doing. But in itself, relative to the share price, it was not a great set of results. The market was expecting higher earnings growth. SPAR, I quite like SPAR. I think it's cheap enough. But I must admit, the Poland sale was just too bizarre for words, to be honest. Look, I'm selling the business to you for 178 million rand, but then I'm going to stick 4 billion in, but then you might have to pay me, I might have to pay you the 178 million back. I mean, I don't understand it. If it's that bad a business, why didn't you just close it?
Yeah.
As far as I understand, they're recapitalizing the business by more than what the debt the business has got.
Yeah. And I remember
it's costing them more to sell it.
When they bought it, I remember chatting with the then CEO, and he's like, we only paid €1 for it. Yeah, it was a lot more than €1 but by the end of the day. Supergroup results came out earlier today. Tough set of numbers. I mean, revenue was up. Almost everything else was down. They're talking around struggles in South Africa, around currency exchanges. Wayne, Supergroup as an investment option?
Look, Supergroup did a magnificent turnaround, a decade ago, from a really, really bad situation. And they've done extremely well since then. And, compliments to management for that. This last set of results didn't look that great to me.
Yeah. And it's Europe.
It didn't look that great to me.
It's in Europe and the UK. That's where their problems are. these are the areas that are supposed to contribute positively, but dragging them down. They're doing okay in South Africa. They've got a whole lot of issues as well. But again, it's a business that we had high hopes for. And I think it's just economic conditions that have dragged them down. And, one hopes that as things improve globally, that they're able to turn these things around. I don't think there's anything structurally wrong there, and that's important. If there's nothing structural, then turnarounds can come fast. Where it's structural, I think that's a big issue.
Yeah.
In other words, where the foundations are cracking, and like in Pick and Pay, it's structural. That's a worry.
Question coming through around Total stock down markedly today. I had a look. I couldn't see any news. I don't know if either of you have any insight. It's a moderately low liquid stock. It just looks like someone's trying to exit.
Which one was that?
It's Total.
Oh, it's Total. No, I don't think there's anything.
Yeah.
They're very open with where they are. The results are, once again, I think we've discussed the issues that they have. It's down. I don't know. No, it's down ex-dividend.
Is it ex-div?
No, in fact, the dividend was 22 cents, but it's down about 87%. Sorry, 87 cents as I look now. So a lot of the falls are related to the dividend, but it's more than the dividend. But this is not a bad business. It's just been beset by the problems locally. No people are, no one's building, no one's doing their renovations anymore, and there's a lot of competition coming in there. But I've watched them over years, and again, I say it's the kind of business that can turn around when things move in their favor.
Yeah, Wayne, if we throw a cash board into that pot, because if we roll forward a year or two with lower interest rates, inflation down, petrol prices coming down as well, a better positioned consumer, these stocks are going to benefit.
Yeah, and you look when you look at the potential to do better, it's actually quite significant in relation to the current base that we're in. Well, maybe not right now, but certainly 6 months ago, with all the heavy load shedding. So interest rates might come down more and quicker than what people anticipate. That's great. We're getting this boost from the two-pot system. That's also great. We hopefully see some commodity upcycle, which boosts the economy in general. That's good news. With the rand below 18 and Brent crude down at 71, we'll see another big petrol price drop next month. So all of this is panning out quite nicely for the domestic consumer-orientated shares, and certainly Total is a very good share. It's a good company in a very difficult industry.
Yeah. Yeah, and the consumer is cyclical. It's been a tough 4.5 years ever since the pandemic. Let's go to some stock picks. Wayne, you're going with AT&T.
Yeah, very simplistically. I mean, I know the share price has run hard, but it's still sitting at it's obviously everyone knows the business and it's a good business, but it's sitting still at a relatively low price earnings ratio, and maybe more importantly, a 6% dividend yield. Wow. And for an American company, that's a high dividend yield. So that's really why I'm going for it.
Yeah, 6% in the US is I mean, I listen to some American commentators who get excited about 1.5 or 2%. I'm like, no, we don't get out of bed in South Africa for that sort of dividend. David, you're going with ASML.
Oh, hello. It comes up often. I think they've pushed this down a little too much. And if you listen to Mr. Trump and Kamala Harris, and then going through the Apple results, no one's going to stop making chips. There are going to be more and more chips of higher quality, higher standard. This is going to underpin the growth in technology that we're going to see, whether it's AI or whether it's just for your electric car, whatever it is. And they're in a monopoly or a biopoly. What is it? Oligopoly. There are not many people. Well, I'm trying to think of the right word. Duopoly, I think it is, because there are not many companies that make the machines that you need to make chips. And yes, they said that 24 was going to be just a flat year, but I think from 25 onwards, you're going to see this growth. And whether they're affected by China or not is not a big deal in their lives. But for me, it's getting into that very cheap territory.
Yeah, I take your point. I mean, we could throw TSMC and Nvidia into the same sort of, sort of almost a monopoly in a sense. They own that space, and weakness is perhaps opportunity more than anything else. That's all for tonight's Stock Watch. Thanks to our guests, David Shapiro from Sasfin Securities, going with ASML, Wayne McCurrie from FNB Wealth and Investments with AT&T, a 6% dollar dividend yield. Up next, the close. Stay tuned.